Hello, everyone. Welcome back to SEC Roundup. My name is Tom Zucchero. I'm one of the board members of ICAN, and with me is my fellow board member, Nick Morgan. Good morning, Nick.
Hey, Tom. Good morning.
We're privileged today to have a very special guest, Evan Williams. Evan is the executive director of the Center for Capital Markets Competitiveness at the U.S. Chamber of Commerce. Hello, Evan. Welcome to the show.
Thanks for having me. Nice to be with you.
So we are going to talk today about a recent rule that we believe the Chamber of Commerce is unhappy with. It's the share repurchase modernization rule that was adopted recently by the SEC. Nick, can you give us a quick summary of the SEC's new rule?
Sure. And it's, we've had a number of episodes where we talk about the flurry of rulemaking activity over at the SEC. This is one among the flurry, and it deals with the level of disclosure required by public companies when they engage in a share buyback or repurchase program. That topic is a topic, in other words, the topic of the wisdom or not of share repurchases is a topic that's been bouncing around for some time. Some people like them, some people don't. Some people think companies should use their cash in one way or another way for buybacks, for dividends, for something else. And so what this rule does, which was, by the way, was passed earlier this month or finalized earlier this month, is increase the disclosure burden on public companies. So it doesn't outright prohibit share repurchases and buybacks, but it increases the disclosure obligation. So, for example, the companies would have to compile daily repurchasing activity as opposed to monthly. There's more disclosure around insider trading activity. So it's not an outright prohibition, but in the words of Hester Peirce, it addresses the issue in the way that only regulators can. More disclosure, more burden on public companies, thereby discouraging the practice. The SEC says they're neutral as to whether they're in favor or not of the actual share repurchases, but in fact, this adds another burden on that course of action by companies, and thereby at the margin will discourage it. So when we saw the chamber filed its petition in the Fifth Circuit, we thought, what better time to talk to Evan?
Well, even at the SEC, it was controversial. There were two dissenting votes when it was adopted. So, and Evan, I know the U.S. Chamber of Commerce has filed a lawsuit challenging the rule. Perhaps you can tell us about your lawsuit and why the chamber felt it was necessary to file it.
Sure, absolutely. So kind of first and foremost, the chamber never sues just because we don't like a rule. We challenge regulations in the courts when we perceive that we can improve outcomes for our members and their stakeholders. So in this circumstance, we've brought a suit against the SEC over their stock buyback rule because it's onerous. It compels companies to disclose information that will not be material to most investors. And it will require companies to discuss the objective or rationale for engaging a buyback, which in our view is pretty overtly political. So we've determined that stopping this rule will create a better business environment for our membership. The hundreds of companies across the country who engage in share repurchases, as well as investors of all stripes. So in our view, this rule has kind of a couple of key vulnerabilities. First, the commission's justification for the rule itself is pretty weak. In its cost-benefit analysis, the commission basically fails to justify the need for the rule. So the rule is predicated on the claim that executives inappropriately use stock buybacks to manipulate share prices to their own gain. The SEC relied on some research from former SEC Commissioner Robert Jackson to make that determination, to make that claim. But during the rulemaking process, we went through Commissioner Jackson's research and found that if you just removed a couple of outliers from the data set that he introduced, that we could pretty much demonstrate that there's no nefarious activity happening. It's more the coordination of share repurchase programs beginning and executives choosing to sell their stock after a blackout period, right? So due to the corporate calendar rather than any kind of insidious activity occurring. So the SEC says that it needs that it needs this rule in order to justify, or it needs this rule to help to determine where nefarious activity may be occurring in the market. But why you need those disclosures on a daily basis is kind of lost on us. Second, anyone who follows the SEC knows that the commission has been rushing out a ton of rules recently and has provided remarkably short comment periods. In this circumstance, the SEC opened its comment period, I think 3 separate times to ask for new information. And at each time, it opened the comment period for a laughably short amount of time. And then third, again, on this objective or rationale disclosure, we think, it is overtly political in nature. The SEC has a lot of authority to compel information from public companies, but those disclosures have to be grounded in the SEC's tripartite mission of capital formation, protecting investors, and maintaining fair, orderly, and efficient markets. Asking companies to justify their buyback activities in an SEC filing doesn't advance any of those goals in our view. And more adds to the narrative in Washington, D.C. about stock buybacks as a whole. Stock buybacks as a whole are under fire here. The president spoke against them in his State of the Union address back in January. The Partisan Inflation Reduction Act instituted an excise tax on stock buybacks, for companies who engage them. And there are a number of bills floating around in both chambers of Congress to try to limit or end buybacks altogether. But as opponents to buybacks will tell you that they basically see it as a binary choice, right? When you engage a stock buyback, you're either choosing to enrich your shareholders, or you're choosing to invest it, or you could use your that cash to invest into additional research and development that might be good for society, or invest back into your employees. But the truth is that stock buybacks are primarily an efficient tool for companies to manage their excess cash, that also have benefits for local economies and are good for everyday investors. Our research from 2011, from the fall of 2021, shows that stock buybacks help companies weather volatility, which in turn also has stabilization effects for the returns of investors. And, I think it's tempting to think about investors as being, corporate bigwigs somewhere. But in reality, as we all know, investors are pensioners. Investors are people who are saving for a house or saving for education, right? Saving for retirement. It's not their, everyday investors benefit from stock buybacks in this manner. So we see, this lawsuit as the opportunity to try to help correct some of the narrative on stock buybacks more generally as well.
Well, Evan, good luck with the lawsuit. It sounds like it's you have very tremendous goals for the case, and good luck in getting some modification, or at least some review of the SEC's rule.
Thanks very much. Appreciate it.
Thanks for joining us, Evan. Nick, thank you as always, and we'll see everyone again at the next SEC Roundup.